Matthew. Thank you very much for joining. Today we're going to take a look at the gold price over the last 50 plus years since we have had the Nixon shock in 1971 and gone off the gold standard. And we're going to see how the change in the price has evolved over the last 50 years and what conclusions we can draw from that. So, as always, I like to draw trend lines here. This is an exponential trend line on linear scale. All right, you see gradually slopes up here exponentially. Not a huge elbow, a huge bent to the curve as we get closer to the present. But I'm going to show this not on linear scale, but log scale as we go through it. So here I'm going to put this on log left. There we go. And remember, when there is an exponential growth or exponential trend line in nature, in financial markets, wherever, you put it on log scale, it's going to be a straight line no matter what. Okay, so there it is. Straight line for the gold price. I also have here these percentile bands, or sometimes I call them the standard deviations. Remember, finance does not move in a bell curve, so that's why it's actually better to use percentiles. But you see here, the 2.5 percentile, the 97.5 percentile, that is these red bands here, the 97.5 on the top, the 2.5 on the bottom. And basically, if the price touches that or moves outside of these bands, that would be defined as a 2 sigma move, where it's outside of 95% of the observations. A 2 sigma move would be if it goes outside these red bands on the top or the bottom. Okay. And really just the point of this video from here, I've shown this video before last year. We've shown this over Bitcoin with a power curve, a power law regression. An exponential regression for the gold price does create a nice line here through the price over the long term. But you see there in the tooltip, I have a 76% R squared. It's not bad. It's not as good as the Bitcoin power law R squareds, but 76%, again, all that's saying is that the trend line fits the price. The price moves up or down around the trend line 76% better than it would move around the mean. So it's not bad. It's not an amazing goodness of fit, but it's also not bad. And why would we say it's not so great? Well, it's kind of the way that the price moves inside of these bands. And you see here, for example, this 2 sigma move in the 1980s, famously, which was just only 10 years after the gold window was closed. The final vestiges of the gold standard were removed. Gold was screaming to $850 an ounce for about 2 seconds. Paul Volcker famously closed the window here. Didn't close the window. He pricked the gold bubble. Nixon closed the gold window. Paul Volcker pricked the gold bubble by taking the Fed funds rate up to 22% here in December 1980, and was right around then. You don't see the actual 2-second top of $850 per ounce. You only see the monthly tops of around $600 per ounce. That was the top. All right, so that was a 2 sigma move, and then 20-year bear market until the start of the 2000s. Gordon Brown, amazing timing that he did for the British people, sold all the British gold at this point. Amazing. This is exactly when gold is hitting a 2 sigma down move, where you would actually want to be accumulating gold. All right. And then back up to the global financial crisis. Doesn't quite hit a 2 sigma up, but get close to $2,000 an ounce, $1,800 an ounce here in the post global financial crisis world. And then we're in a bear market as well for a few years until now. It's finally back up, and as of December 2023, $2,078 per ounce. Okay, so the lesson here is to say, obviously, these trend lines are not going to give you, perfect fit in the financial market, like perhaps they give you better fits in the natural world or in other sort of biology, physics, statistics. Sometimes the fit can be much better. 76% is still good, though. Shows you bottom left of the chart, so the upper right of the chart. But now let's look at the actual slope of this curve from a compound perspective and see if we can use it as a benchmark. Okay, so there you see in the tooltip, 8% CAGR. What is that? Compound annual growth rate, 8%. And right next to it, I also have 9 years. Okay, so 8% compound annual growth rate translates into a 9-year doubling of your principal of your base. So that means that this exponential trend line of gold at 76% R squared will double every 9 years, or an 8% per year compound annual growth rate. Final disclaimer or thing to learn from this, of course, you're not always going to be on that trend line. In fact, you pretty rarely cross above. We're looking at the black line now. Let's take the percentiles off. Pretty rarely cross above the trend line, hit it, and cross below the trend line. It's pretty rare. It's only a few times in the 50-plus year history where we've crossed it. And right now, you can see we actually bump along it, the all-time trend line, which is interesting, a little bit above. But of course, this 8% per year, it's all going to depend on when you come into the market. Okay, so here, if you came in at the top, which again, Paul Volcker had to prick this bubble at $600, $700, $800 an ounce, and then you sell here at Brown's bottom at $200, $300 an ounce, you're going to get well below 8% per year as a return. And even if you sell, you buy here at the top again, and you sell somewhere here in the 90s at the trend, you're going to get below an 8% compound annual growth. The only time you'll get 8% compound annual growth is if you buy somewhere around the trend line and you sell somewhere around the trend line. So you definitely can have that happen here, right? In the 70s, sell in the 90s, or keep holding, sell in around the global financial crisis, sell somewhere here in 2018. But, this is not day trading. This is measuring a market, showing you the actual growth over the long, long term. And sure, you can outperform this by buying here at Brown's bottom, selling even well above here, getting close to, a 2 sigma move up. That's going to give you well above 8% per year returned, or doubling your investment every 9 years. But it's just to show you the trend lines, I think, can again help remove the noise. Gold is an interesting asset, but I can't tell you how many newsletters I've read over the last, let's say, 15 years since the global financial crisis, which have claimed gold is going to scream, the dollar is going to fail. This trend line, these percentile bands, simply prove otherwise. There are interesting new technologies, monetary technologies, such as Bitcoin, which I think can show you a different picture, as I've shown these before, and I will continue to show this again. But with gold, you're looking at 8% per year if you follow the trend. And we can also extend out beyond today. Let's go out to 2030. 8% per year per gold will give you about $2,400 an ounce by 2030. Again, past performance doesn't equal future results. It's not it's just a statistical prediction. That's all that I'm doing here. It's simply a statistical prediction. It's not a hard and fast prediction. But you can see, it'd be pretty rare to be outside these red bands as we continue out into the future. So there it is, gold over the last 50 plus years, 8% per year, doubles every 9 years. Interesting asset, but there certainly are other assets out there that can protect your wealth and are new digital monetary assets for the time. So I'll follow those as well in future videos. And of course, you know that I'm talking primarily about Bitcoin. Thanks for watching.